So thanks for joining. We have a great session on integrating energy storage into electricity markets. Four great speakers. We actually have a slight programming change. I made a executive decision just a little bit before this to switch our first two speakers. So Kenneth is going to go first, and his talk focuses a little bit more on kind of the current situation in ERCOT, and then Serena will go second, and she gets a little bit more into potential reform. So I think it flows a little bit more nicely that way. Then we have two additional perspectives, a little bit more of the financial perspective, and then getting into kind of an owner-operator perspective as well on energy storage in an electricity market. So I think it's a great session. I also think it kind of builds on, for those who are in this room, for the last session, kind of builds on some of the LDES conversations we had in that one as well. I'm not going to take a whole lot of time to do any preamble or introductions. I think it's better just to let the speakers get into things. Going to try to save a fair amount of time for Q&A at the end. From what I've seen so far, there's been no shortage of questions. I have a few, potential discussion points as well that we can get into and try to use, a fair amount of time for that. So I guess without any more delay, I'll hand it over to Kenneth to talk a little bit about ERCOT.
All right. Hello. Yeah, I'm Kenneth Ragsdale with ERCOT. I've been there quite a while, so I think he wanted to let the old guy go first, so I'm glad to do that. I've got a lot of slides here, so don't get frustrated if I skip a couple of them, just to kind of make the right time. But here's kind of the outline. I'm going to go through some background, and then where we are, how did we get here, where are we going. I think that's what everybody's trying to figure out, is where are we going with all this stuff. And then I tried to stay focused on the real-time co-optimization plus batteries project, and especially the battery part. That's a project that we hope to go live with on December 5th this year. Some people would say we've been working on this since 2012, so we're real excited to get this thing in. And I don't want to talk about the past too much. I want to try to concentrate on the final state of what we hope to get with. And then I go into some specific topics and details, so that by the time we're all done, any of you guys could go to ERCOT and make a bunch of money with your batteries, I think. So let's see how it goes. So yeah, I've seen different versions of how things have been changing on the grids across the US. This is a picture of ERCOT. I actually started in ERCOT back in 2000. So we used to do settlements with a Big Chief tablet and a crayon back then. But you can see that it's really only been recently that you see a sharp increase in the wind, the solar and the wind. And you can see the red line there of storage, pretty sharp increase. I have some more data here. First, I wanted to pop to the most recent interconnection queue at ERCOT. This is the June 1st date. And the biggest number on the page is the 174,000 megawatts of batteries that are in the queue. That's the highest number it's been in the queue since I've been looking at it. And if you look at the far right bottom, that is the megawatts of batteries that's been in the queue each December 1st. So it's been a real sharp increase. And along with that is the wind and the solar. I did see a statistic that between last summer and this summer, we've added about 9,000 megawatts. It's mostly been solar and batteries. And there's actually been a net decrease of gas of about 350 megawatts. So, the change is happening. It's continued to happening. Then I'm sure some of you guys have seen this. Again, back in 2012, when we put our first battery on, we didn't have much on the system for quite a few years. We did a lot of improvements. We followed what was done with FERC 841, and we made some other improvements. But the yellow arrow is where we are today, close to 13,000 megawatts. Maybe by the end of the year, we might have 18. And the maroon is stuff that's kind of financially secure. Financially, security has already been posted. The green is a little less certain about being there, but you can see some big numbers there. 27, we could have maybe 40,000 megawatts of batteries. And if you are really interested in the history, you can go through those 12 steps of all the things we did. One thing that's interesting about ERCOT is early on, we allowed people to update their offers anytime they wanted to update their offers, which I don't think many of the other ISOs have done. This is really hard to read. The summary of this is in ERCOT, the operational batteries we have are usually like 1 hour, and some of them are 2-hour batteries. The batteries that are in the queue are a little longer duration, but they're not anything close to what's in California, which most of their batteries are 4-hour batteries. And that gives us some unique challenges. It seems like we're always running on the close to empty or running on close to full. So we have to be a little more careful with that state of charge. I wanted to show quickly some data on how the batteries have penetrated our ancillary services. And here's the last 3 summers. We'll see what happens this summer. The key takeaway here is the dark black is non-spin. You don't see the batteries doing much non-spin, and we'll go through that a little bit. But a sharp increase in the regulation, RRS, and ECRS just started back in June of 2023, and they're doing quite a bit of ECRS in our ancillary services. Okay, I'm probably going to skip this graph. The punchline is we have this 4CP concept in ERCOT where everybody's trying to do load reduction when we have the maximum load in ERCOT, but the batteries are injecting to the system when they see the high price or when they think the high price is there, and you can kind of take a closer look at this picture. And that's what we would expect them to do. So just real briefly, the real-time co-optimization, again, that's something we've been working on for a while. When I said the 2012, when we first put in that first battery in a pinch, we said, well, we don't have a model for a battery, so we used what we called the combo model, where we modeled it as a generation resource and a controllable load resource. And we thought that would be a temporary workaround for a couple of months. And here we are, 13 years later, finally making a change with this single model. But the real-time co-optimization is another key thing that that we worked on with this project, and that is today we don't really have a real-time market on the ancillary services. Everything's procured in the day-ahead market, and pretty much that is carried over into the real time. The QEESs, qualified scheduling entities, can make trades and move stuff around within their portfolios, but there's not any type of new, fresh look of where's the best place to carry these ancillary services. And there's not any type of real-time co-optimization of this energy and AS. And so, sorry about that. And so this is the picture with the real-time co-optimization. We have the energy and AS co-optimized. We now have ancillary service awards in real time. We have real-time ancillary service prices, and we're able to look at the whole system and, based on the offers that have been submitted, optimize the energy and AS. And it really is a real-time efficiency that we're getting through this real-time co-optimization. What's key for the batteries is, as their state of charge changes and as their capability changes, it's not just what's in their portfolio and it's not just who they know. That responsibility can be easily moved around through ERCOT's process through this real-time co-optimization. So then I was going to briefly go through kind of the specifics of the battery parts of the project. The first one, and these are what we call nodal protocol revision requests. 1014 is the single model, and we went through and we wrote all the details of what the single model needs to look like. I'll go through that a little bit more. We had another NPR where we talked about the considerations of state of charge, and we're trying to be careful in ERCOT is we're not managing state of charge, we're trying to monitor it, and we're trying to give you information of, here's the AS duration we require. You know all that. You need to manage your state of charge. And then ultimately, in many cases, what we're doing is making sure the outcomes of our SCED process respect what your state of charge is, respect what the duration is, and we won't over award you in that SCED process for AS. And then there's some terminology we had to change. 1282, this is the durations for RTC, and this is what we want to do for go live. I don't see Nitika's here. She did a lot of work on evaluating, what should these AS durations be, and it was just approved unanimously at our board of directors yesterday. And this is what we're going to use when we go live, and I'll go through some of that a little bit more. It still needs to be approved by the PUC, but we'll talk about that. And then item 6 here, I did want to comment that back in 2020, when we had we called it the BEST Force, Battery Energy Storage Task Force, we did spend a lot of time working on DC coupled resources. There was a lot of interest back then of, as a blob, you have this battery and this PV system, and you see it as one resource. As we restarted the project after Storm Uri. We put that on the back burner and said we didn't see much of an interest in that. And so that is not part of this project. Okay, I'm going to go through some of these kind of quickly. So again, the key is moving to a single model. Physically, it is one device. We want to represent it as one device. So we're doing different things in registration, telemetry. We have now a bid offer curve, single performance monitoring, single settlements, and single entry to our outage scheduler, little details there. Here's just a picture to have in your head of what we call the combo model. This is what we've been doing since 2012. It's this workaround to show it as a generator and as a load. Once we get this single model in, that'll be one resource. And the good thing about it is the meters don't have to move. We don't have to change anything with the metering. We don't have to change anything with the resource node. But now we'll start getting information about that resource as one single model and giving awards to that resource as one single model. I'm not going to go through this too much. We had to make the transition. You know, we always talk about this analogy. We're flying the plane and we're trying to change the engine out while we're still flying through the air. In this case, we're actually changing the passengers. We're going from a brother and sister to this single thing that does both like a brother and sister thing. So we had to come up with new names for the single model. You know, there's roughly, I've kind of got this a little high, 250 batteries out there on the system. So each one of them, we gave them a new name, and we've got a process of making this transition. And we have started our market trials. We're in the first part of it. Again, we're planning to go live on December 5th. We've gotten connectivity. We've gotten the market participants. They've done very good on the scorecard and have participated really well in submitting data to us, such as offer curves, current operating plans. And so we're at that point now. We have some open loop testing coming, some closed loop testing. And again, we hope to go live on December 5th. But here is kind of a quick rundown of what we expect from each of the batteries. And we now see the battery as a plus minus 100 megawatts. And so the low sustainable limit is a negative number, which we haven't had before. And we have already implemented a situation or a process where in this current operating plan where they're giving us information for the next 168 hours, they need to tell us what their hour beginning state of charge is. And what we do is we use the data they send us to get an idea of, you know, are they planning to show up 2 hours before the sun goes down or 2 hours while the sun goes down, ready to push to the grid, or are they going to be showing up exhausted without the energy? So we're still going to use that hour beginning state of charge. We'll get telemetry for the single device. All our systems will see it as a single device, and we'll eliminate some of this workarounds ERCOT's been doing, and also the Queasies, qualified scheduling entities, have been doing in their process. So the two offer to sell, bid to buy is gone. We're now getting one submittal. And again, they can update anytime they want to. Not going to go through that too much. There's some telemetry changes, but the original state of charge telemetry that we put in when 841 went in, we're not obligated to do that, but we saw everybody else do that. We did that back when that was happening. So some slight changes on the telemetry. And then I wasn't going to go through this one too much. One point I would want to make is with this single model, we are moving to a tighter tolerance in terms of base point deviation, going from 5 megawatts plus or minus 5% to a 3 and a 3% megawatt, 3% and 3 megawatts. So we're making sure all the battery owners know that that is a change. You know, maybe they've been scooting under the radar previously. Now they need to be a little more careful. So we're going to make sure that happens. I'm going to slow down on this slide just a little bit. This is a slide from back in March, I guess. The NPR that was approved by the board essentially has this data. And there's 3 columns here: real-time, qualification, and RUC. And what we tried to do for each of the ancillary services, state what the duration requirement is in each one of those time periods, I guess. And the controversy has been, you know, I think it's a classic economics versus reliability. And the one that's received the most attention is the bottom non-spin of 4 hours qualification and 4 hours in real time. So at the board yesterday, we had 4 different comments from different battery owners of how they felt that the non-spin requirement of 4 hours in qualification and 4 hours of Real time was too high. We also had the IMM weigh in and how they saw that that was an inefficient approach in some ways. But what we decided is for the go live, we're going to stick with these numbers. And then I think there was a general agreement that shortly after go live, we would investigate this to see if we could come off of that 4 hours for qualification and 4 hours for real time. And I would note that the change between the combo model to single model really hasn't changed. You know, there was some questions about the RRS qualification. It really hasn't changed that. We are asking people to come in and kind of prove again what they can do in terms of response to reserve service. And we did make a change in the ECRS, ERCOT Contingency Reserve Service, and we've lowered it to a 1 hour qualification instead of a 2 hour qualification. So we can talk about that some more later. I just wanted to mention that in the day ahead market, we still are not looking at state of charge. It is easy, if you're not careful, to over offer into the day ahead market and get an award that your resources may not really be able to support. We've talked about that. Maybe a future item is to try to make changes to the day ahead market. But that's one thing to note. And then when we get to the real time, again, we talked about the single curve, which is the bid to buy and the offer to sell all together. SCED will also incorporate the state of charge accounting within its optimization. So again, it'll look at your telemetered state of charge and say, based on that state of charge, I can only give you an award of this amount of energy. Or in terms of like non-spin, SCED will say, well, I want to only give you an award for non-spin, which is something that you can do for 4 hours for that next 5 minutes. So that's part of the debate that's going on. So again, the awards are limited by based on the state of charge information, duration requirements, and other physical capabilities. And then the main thing this does is it kind of eliminates, I think I said this before, it eliminates the queasy having the pressure to they have some responsibility. If their unit falls apart, they need to go find somebody they can do a trade with or use some other unit in their portfolio to try to make that up, or be exposed to what we call an old SASM, which is a replacement for the ancillary service. All that goes away. We have this process that's looking every 5 minutes, fresh look, where's the best place to do this? I think I have just a couple more slides. So DRUC and HRUC, that's the day ahead reliability unit commitment and hourly reliability unit commitment. And that's what we use to check to see in the future hours, do we have enough generation in the right spot? And I would want to revise this slide. And now we also want to check that we have enough energy with these batteries. We need to make sure that they have enough state of charge to do what we need. So we're going to use that as our basis of making sure we have enough, for example, when the sun sets later tonight. And with this reliability unit commitment process, we're not going to be bringing batteries on. We always see batteries as online, so we're not bringing them on, but we want to properly evaluate what they can do and what they bring to the system. Otherwise, we may bring on units unnecessarily because we didn't take into consideration what the batteries could do. And then the other thing I wanted to mention, I think this is on the next slide here, is again, we're using this hour beginning state of charge that's given to us to kind of get an idea of what they're going to be able to do in the later hours. And we're introducing something called deployment factors to simulate our estimate of what the deployment of ancillary services will be for a particular hour in the future. And the current plan is we post these deployment factors. It's a number between 0 and 1. And if our operator thinks there's a high probability we're going to be deploying non-spin for 3 hours later today when the sun's going down, they will show a 1 in each of those 3 hours. And that lets everybody in the market know at 6 a.m. that ERCOT thinks there may be some type of non-spin deployment, and everybody is aware of that. And the last sentence here is, the other thing we try to do is provide an incentive for queasies to make sure they don't oversell. And if they sell ancillary services, and if they don't have the state of charge, and if we have to go ruck a unit, I'm going to say at 10 a.m. for a later hour in the day, when we go back to figure out who needs to pay for this ruck, we will use that information we have, and they can be found short. And that's kind of the stick to make them think, I want to try to make sure I bring my state of charge that I need to cover the ancillary services that I have. And I think that's my last slide. And I got a minute and 45 seconds to get back to you. Okay, all right, thanks.
All right, thank you, Kenneth. Next, kind of building on that, we have Serena Patel from Brattle Group, who's going to be talking about energy market reforms to unlock energy storage, I think.
Great. Hi, everyone. Yeah, so building off of that, I'm here to talk about this energy storage market design roadmap that we put out with the Brattle Group put out with American Clean Power a couple months ago, working with this excellent team also. And we were mostly looking at wholesale market reforms to unlock energy storage potential in the markets of PJM, MISO, and NISO. And so in this talk, I'll go through like the motivations for this a little bit, and then dive into the 5 reforms that we think are really important for these target RTOs. So first motivation, markets have shaped energy storage deployment. We've seen record levels of deployment in ERCOT and CAISO due to the high amounts of variable generation and along with their enhanced market designs. And yeah, this is an outdated figure, so that's pretty incredible. The other thing that we observed is that markets very distinctly enable storage revenues. So if we're thinking about learning from both of these markets, how to unlock the storage value across the energy ancillary service markets and the capacity markets, we see how in CAISO, there's a lot of revenues for storage coming from the resource adequacy contracts, as well as how they're dispatched in the energy market, and a little bit less so in the ancillary services. In ERCOT, this is from 2022, so this has probably changed for sure now. But here we saw that they were getting a lot of revenue from the ancillary service market. And then in the dotted lines, we have the annualized levelized cost for 2-hour and 4-hour storage. So you see how that is more than enough to build, I guess. And so that kind of brings us to this point of we're seeing record levels of solar and wind that's projected in these next markets and PJM and NISO, MISO, and that's what this figure here shows. However, this growing reliance on variable resources across the country is really going to increase the flexibility needs beyond the limits of how the market's currently designed. So we've identified these 2 main challenges. First, the load growth and retirements are raising the resource adequacy needs. And then second, this increased reliance on the variable resources and without having as many dispatchable fossil units creates these flexibility needs within the system. And that these system needs, if we accurately quantify them, storage is very well poised to meet these challenges. But we're thinking that the market design here, the storage value is kind of constrained by those designs. And that don't address all the system needs or also accommodate the special capabilities and limitations of storage resources, which is also what Kenneth was talking to before with how you need a model the storage capabilities within the system. Okay, so this is just a summary of these key market design elements to leverage storage capabilities. So we have the conventional grid here. Dominant capabilities are slow ramping conventional generators. We have high startup cost and time. They're kind of difficult to install, also subject to limitations in where they can be installed. Whereas in our emerging clean grid enabled by storage, where the dominant characteristics are fast ramping inverter-based resources, they're always available. They can, you can install them more quickly in many different kinds of places. And then that's going to affect how that interacts with the market. So the conventional grid were dominated, the economics were mostly dominated by by the fuel costs of these fossil units, by the fuel availability of the traditional resources, whereas now we're looking at these volatile, high prices, low price periods, and that storage is dominated by the limited energy and opportunity costs of electricity. And then finally, that leads us to these grid needs, where in the conventional grid, we're having modest uncertainty and ramp, simpler peak load capacity needs. The legacy units are kind of integrated into the transmission planning, whereas now we're seeing all this increase in renewables. And this is kind of what I said before, which increases the value of flexibility and resource adequacy needs. And then in addition to that, we are having the retirement of legacy generators within how it used to be planned. So that's creating these transmission challenges, but also opportunities. So given that, we looked at these missing market functions, identified these. This is where the reforms come in, where we've identified these new flexibility products and some design parameters around that. Energy market bidding rules that allow opportunity costs and faster bid updates, and then the capacity market reliability models based off of hourly reliability, and then also better retirement planning. And so that's like touching on the energy and ancillary service markets and also the capacity market. Within this report, I'll mostly focus on, or within this presentation, I'll mostly focus on the energy and ancillary service market reforms, and we'll go from there. So for the first flexibility product that we looked at was this intra-hour ramp and uncertainty product with an operating reserve demand curve. So the concept here is that, which you can kind of see in this figure here, is that at your dispatch at T equals 0, you want to meet net demand at in 5 minutes from now, but you also want to procure flexibility to ensure the system can ramp to net demand in 15 minutes. So this is looking at your intra-hour flexibility needs and pricing that. And it's really driven by this expected ramp up portion because the uncertainty part is a little bit lower compared to maybe longer term things, since the forecast is a bit better at 5-10 minutes out. But the impact here is that you're theoretically able to get a more transparent price to meet growing reliability needs for flexibility. You're theoretically able to reduce uneconomic thermal cycling or unnecessary renewable curtailment. And this is a product that I think people here might be very familiar with. It's been implemented in a lot of RTOs. It's been proposed in ISO, and I guess undergoing the stakeholder process in PJM right now. The second is related. It's an ancillary service market reform product as well, but looking at the day ahead uncertainty. And so this is again getting at, we have this value of flexibility that's increasing, but a lot of markets lack a product that capture that system need. And we don't really see any markets right now that have a full uncertainty product in this day ahead timeframe. The impact here, or like the impact here is that you're replacing out of market actions with also transparent price signals. So you're bringing those out of market, or some of those out of market actions into the market. And so you can get better price signals for how dispatchable resources are available. And that's something that, storage can really play a part in. And then secondly, you can improve efficiency and reliability through that systematic procurement of availability. And that's beyond the day ahead energy commitments. And then going to the figure here, the way that this is that we have conceptualized how it's sized here is that in the day ahead, you kind of have this physical supply that's cleared in the day ahead market that doesn't always meet your like 50-50 demand forecast. And so you have this energy gap. And then you also have uncertainty on top of that because your forecast in the day ahead is not going to be the same as what happens in real time. So there's this uncertainty portion. So your uncertainty product should cover both of those. And so that's why we have this check mark in where it's been implemented. ISO New England has implemented this, but it's only looking at the day ahead energy gap and not the uncertainty part. Whereas NISO also implemented something like this, but only sized by the uncertainty portion and not looking at the energy gap. So kind of opposites there. And then it's pending implementation in CAISO. MISO, I don't know, doesn't have one. PJM going through a stakeholder process. So yeah, those are like the two bigger ancillary service market reforms. Going into the energy market reform, we were looking at opportunity cost bidding to enable competitive and efficient energy offers. So the idea here, we probably have touched on this already too, but essentially storage operators are willing to sell energy earlier in the day at the forecasted price later. So they're basically, you have these high price periods during your peak hours, and you are a duration limited resource. So if you discharge too early in the day, you're not able to get the revenues later on in the day. And so they incur an opportunity cost if they're dispatching at the wrong time. And that should be priced into how they're and how they offer, basically. So the impact potential here is quite huge. We'd say you have increased reliability, where storage is incented to be available during the peak demand or scarcity hours. You have an enhanced market efficiency, so all the market operators like this more. Your true offer costs are reflected, and you get more flexibility if you're procuring more storage. And that they would, like storage, since storage can provide all this energy and reserve and frequency regulation, these very valuable resources. And then finally, on the storage operator ends, you would get more revenue clarity, and that would encourage more efficient investment. So we see that storage can pretty much bid their opportunity costs in CAISO, MISO, and NISO, but not in PJM at the moment. And that's a problem. So then our fourth reform here is looking at, it's actually not a market reform per se. It's meeting the needs that the market has failed to address. So this is looking at the post-retirement of a large generating unit. They often have these like local reliability needs, and basically the RTOs might say they need to stay online and be a reliability must-run unit or something like that. But they often don't have strategies to procure other kinds of resources. So like non-wires alternatives could probably serve that reliability need at a cheaper cost, but or maybe they can't, but they don't really have a process in place to see if that's possible a lot of times. So CAISO and NISO seem to have a process in place to do this for the reliability. Like, so this on the screen here is NISO's reliability planning process. But we don't really see that in MISO and PJM. But this could be really important because you could, select the most cost-effective solution from many different types of options, which could lower bills and also facilitate some kind of quicker adaptation to transition. And so there's certain kinds of storage resources which maybe more longer duration storage resources could fit this kind of need too. And then finally, I'm not going to actually go into this one quite so much, but we did look at capacity market reforms. Our scope was quite limited in this report. We were just looking at assessing, two previously identified topics that underestimated storage capacity value, and not really looking at the core risk modeling that happens. So there were two main things that we looked at, and this is just to enhance how accurately storage or storage dispatch is in the reliability modeling. So one is changing how it might be dispatched. And then, and so we have like these three options here from MISO. And then the second one is changing the dispatch order in reliability modeling. So, and that's between mostly like demand response or storage. So like, which one will you be dispatching first? That's going to, which one would you dispatch first in a reliability or stressed system condition scenario? And that's going to give different accreditation values to both of those resources. So that was that one. And finally, I just have a summary slide here of all the different reforms. And yeah, we also have different fact sheets and the full analysis here. We have it broken down by each ISO, the different reforms that we think are really pertinent to each of the ISOs. And then of course, this is the rest of the team here that was also involved in this report. So happy to answer any other questions on this and pass it on to the next speaker.
Thank you. Great. Yeah, thanks, Serena. That was really interesting. I have a few questions, so maybe I'll get to work those in the Q&A at the end. So next we're going to turn to Farhad Billimoria. It's going to talk a little bit more about contract design for ES, so getting a little bit more into the resource perspective. And yeah, maybe just providing kind of that contrasting, market design versus kind of out of market contracting perspective. So please. Yeah.
Thanks, Todd. Okay, cool. So what I'm going to talk to you today about, as Todd mentioned, is the contracts and the financial side for storage. I'm going to talk a little bit about the rationale and so why we kind of need it. We're going to talk a little bit about the main forms of contract design that we're seeing in the market, and then talk a little bit about the incentive impacts of those contracts on the way that markets are operating. So this is relevant from both sides of the perspectives of a market operator, where contracts are going to impact how the physical unit behaves in the real time, as well as vice versa, how real-time prices are going to impact things like contracts. And then finally, what we're going to talk about a little bit about how to value and price these types of complicated contracts. Cool. All right. So why is this important? Well, a lot of what actually we've been talking about today, as well as the last couple of days, has been around forward markets, right? When we talk about the physical markets, the only real physical market that exists is real-time markets. And as we get further and further away in time, the more we get towards forward markets for contracting, for commitment, and then we're getting into forward markets for making investment decisions over the medium and long term. So this is critical to understanding how resources participate in the market. Okay. So what's the rationale for contracting storage, especially when it's such a flexible resource? And it really varies across markets. And you can kind of see the disparity between ERCOT and CAISO as two examples here. And a lot of the drivers for a market like ERCOT is related to volatility. Okay, you can see, especially where you've had scarcity in the system, Winter Storm Uri, with Elliott, with more recently, the volatility in these markets makes it much more difficult to secure investment, because what a lot of investors are looking for is long-term stability in cash flows. And so when you look at this type of profile, it's hard for a bank or a financial institution to underpin this. And so they need some sort of certainty or some sort of contract framework which gives them more of that confidence that that asset is able to be financially viable for its lifetime. In CAISO, the story is a little bit different because value is less concentrated in real-time and spot markets and more in markets like RA. And so the value for resource adequacy is a particular aspect of contract design in CAISO. And so that varies across markets. And this is sort of two bookends really around how value is examined. Okay. Now, so as I was talking a little bit about, battery offtake agreements provide support to unlock debt financing. And debt financing still is one of the major sources of capital for finance across the power space. So you need to be able to get the bankers happy to be able to make equity and the rest of the capital structure come along so that you can actually make these investments work. And because of that volatility that I've talked about, the other challenge is managing some of those and the diversity of revenue streams across the market. Now, particularly because electricity markets have a range of value streams that are attributable to storage, from wholesale to ancillary services to capacity, there's an increased benefit for contracting to again provide that stability against all of those volatile and varying revenue sources. And there's a set of examples in terms of how contracts are structured across ERCOT, across CAISO, as well as an international example from Australia, which adopts a very different contract structure to what we're seeing in many of the markets over here. Okay. All right, so now I'm going to just talk a little bit through some of the common structures that we see in terms of storage, offtake, particularly for markets like ERCOT, tolling arrangements, which are essentially the closest way you can think about it is kind of like an annuity stream. So what you do as a storage operator or owner is you receive a premium, so typically a fixed premium, in return for providing your spot exposures to the offtaker. So it's kind of like a contract for difference. Now, one of the common structures, particularly for markets like ERCOT, but also CAISO, is for these tolling arrangements, asset dispatch rights follow the financial flows. And that's really important, as I'll talk about in terms of incentives. Another emerging structure, as we move more towards financial structures, as opposed to sort of physical and operating right transfers, is a range of designs that start to build in some of these value disparities that we're seeing in the market. What you might see as TB or top-bottom spreads, spread swaps. Again, a return where the battery owner receives an annuity, but now what you're receiving, rather than the actual revenues associated with the battery in the day-ahead and real-time markets, is you're receiving a floating rate based on top and bottom spreads. So this is where you're basically looking at the top 4 hours, for example, say in over a day, and you're taking that away from the bottom 4 hours. And so you get kind of like a proxy spread for what a storage unit would expect to earn if it was kind of almost like a perfect foresight model. As we get more and more granular, you've got contracts around ancillary services, swapping some of those volatile revenue streams for more fixed rates. Revenue puts and collars are particularly popular in ERCOT and in AEMO in Australia. And these are essentially a cap and a floor on the amount of revenue that an asset, the storage asset, earns in the market. And so the idea here is to provide a floor so that you can, again, support debt financing. But you also, in return for that, you need a cap. Because if you're going to do it as a zero cost collar, you need to be able to provide a cap so that any returns above, let's say, a windfall gain are returned to the offtaker. And so that provides kind of a bounded revenue framework for the unit to operate in. And then you've got a range of RA contracts, particularly for markets where RA is a big component of the value stream, CAISO being a key example. And then we'll talk a little bit about index storage credits, which is NYSO's approach to providing long-term certainty for storage. Okay, so I talked a little bit about the toll. And essentially, as I mentioned before, what we're doing is exchanging fixed cash flows for floating cash flows. Okay, the floating component is essentially this energy and ancillary and capacity revenues of the unit. Now, one of the really important things for this contract design, when we're talking about incentives, okay, if you think about a storage operator. Now, if I'm participating in the market and I'm exposed to the volatility of that market, I'm going to make sure that my operations are in line with what we're seeing for market prices. And I'm going to try to do my best to ensure that I'm aligned with what signals are coming out of the market. Now, if we move to a full toll and I exchange those for a fixed rate, all of a sudden my incentives disappear. Okay, I don't have any ongoing financial incentives to monitor and manage that asset in a way that's consistent with the signals that's coming through from the market. And so that's why we see quite often is trading rights alignment. The financial flow, the operating rights will follow the financial rights. So it's the off-taker that tends to manage that asset. Now, that may not be the case for every off-taker. There may be folks that don't actually have the capacity and the capability to manage these assets. Now, you can, of course, get someone else to manage you can contract that out, but there's also other ways of structuring the contract so that you continue to maintain incentives. What we've seen in the markets are partial tolls. So that's where the existing storage operator retains an exposure to the asset, as well as what we call virtual tolls. So these are benchmarked performance metrics. So that this is essentially a way of saying you need to beat this benchmark to get to obtain additional revenues in the market. And that maintains the incentive for the operator to continue participating optimally. Caps and floors. Now, this is a pretty unique contract design that has been put into place in many centralized frameworks for storage procurement. In Australia is probably the biggest example where AEMO, the market operator, is running, has run a set of auctions for contract hedges associated with a cap and floor structure. So this is essentially where they cap, if you're a storage operator, you have a cap on your returns every quarter, as well as having a floor against low returns. So you're essentially bounded and you're operating within this sort of financial range. Now, one of the challenges of this type of structure is what we call the doghouse problem. Once units reach a particular cap, we are in a position, again, similar to what I talked about with the toll, where the unit has limited incentives to continue to operate in the market. And that's really important because quite often in times of volatility, you will reach this cap really early in the quarter. And so this means that you might be 10 days into that quarter, and all of a sudden you've hit the cap. And so there's limited ability for that, or the limited incentives for the unit to continue to participate optimally. And so this really creates challenges for market operators when they see storage units not behaving intuitively. And so they come to us a lot with questions around why is that so? And ultimately it goes to incentives. Now, there are a range of mitigations against these types of this type of issue. One is what we call a soft cap. So that's where almost like a revenue share. So where when you reach that cap threshold, you continue to maintain the incentives of the unit by sharing the revenues. So instead of having a full cap where you don't get any further revenues, maybe you get 20% or maybe you get 50%. The Australian energy market operator uses a 50-50 sharing framework for caps, but there are other frameworks out there as well. The other aspect that we're seeing, particularly for private contracts, is what we call yardstick contracts. So this is where the storage operator has essentially a benchmark. So they're not being judged against actual revenues, they're being judged against benchmark revenues. And that's, again, another way of creating that or maintaining that performance incentive for battery operators to continue participating optimally in the market. One of the aspects where we have seen this is with OEMs and battery optimizers, where they're essentially guaranteeing performance. So they say, hey, I will guarantee you a percentage of those perfect revenues, and I'll provide, and in return for that, I want an upside share above a threshold. So these are real world contracts that are being currently negotiated. And so if you're a central market operator considering these types of frameworks, you've got to consider incentives, because the last thing you want to do as a market operator is run these auctions, but then have the units not respond in the way that are actually system optimal. Okay. In the last couple of minutes, I'll talk through a couple of the other contracts. This is what I talked a little bit about before, the TB or top bottom spreads. Again, similar to the offtake contracts, but instead of actual revenues here, you've got essentially the top 4 or top 2, whatever that number is, hours minus the bottom 2 hours. And so again, it's a proxy. It's a form of metric, right? A proxy metric for judging storage value in a system. In CAISO, we have a range of contracts that are common. So tolling arrangements, I will caveat that we do have a lot more tolls in the system. People just don't tend to report it in the FERC EQR database. But a lot of the data that we do see, and that does get reported, tends to be split across RA-only contracts. So we're essentially selling your RA value over long term, or what they call RA with energy settlement, where you're essentially providing, you're netting off against this type of TB structure. So again, illustrative of the diversity of contract styles that we see across different markets. Finally, in terms of common contract designs, I just wanted to talk a little bit about the New York Index Storage Credit. And this is quite a unique structure because what it does is not only provide a swap against energy revenues under a TB structure, so similar to what I've talked about here, but it also provides essentially a hedge for RA revenues. Now, typically we've thought of RA as being a real stable revenue source, but talk to anyone from PJM that's been around, that's been operating PJM over the last year or two. And so RA is itself a highly volatile stream. Okay, so this is one mechanism to try to manage those risks. Finally, in the couple of minutes I've got left, I'm going to talk a little bit about how you get your head around valuing these assets. And I think some of the formatting here is stuffed up, but anyway, that's fine. So we look at it from a couple of different perspectives, and we have advised a number of clients in terms of getting their head around some of these complicated structures. And essentially, the way we think about it is there's not just one value, it's actually a bound. And it depends on the perspective from which you approach this. One is from the off-taker side, where essentially what you're looking at is the fair value of each of those individualized revenue streams built up to kind of provide essentially an expected or fair value of the asset, and then accounting for some degree of risk or uncertainty in the market to kind of provide that upper bound for what you'd expect to see for each of those value streams over the long term. On the other side of the coin is the lower bound, and that's the developer perspective. So that's essentially looking at it from a capital asset perspective of what amount of financial flow do I need to make me money good, to essentially make me whole, make investors whole, allow my debt to actually get paid and allow equity to get its return. And that forms the bottom, the lower bound. And so price tends to vary between these bounds. How wide are these bounds? So this is an example that we've done for ERCOT last year and kind of looking at tolls, the price and fair value for tolls under some of these structures. And so when you look at that upper bound and lower bound differential, especially for the shorter durations, they actually can vary quite a bit. And the reason is because you've got quite a big gap between the money good value of the asset and what each of those revenue streams are being seen in the market. As you get to higher and higher durations, that bound reduces primarily because the cost of the capital cost associated with longer duration storage is still relatively high compared to the fair value. And so you see that bound shortening. Okay. So what are some of the key takeaways? And I think I'm going to leave you with probably 30 seconds to go. Market or centrally based hedging schemes are essential to risk management of volatile revenue streams for electricity. Electricity is, when you look at it from a commodity perspective, one of the fattest tail commodities around, right? And when you do the stats on this, it is quite amazing to see the volatility that all of us are exposed to every day. So hedging is a critical aspect of not only financing, but also operations, because it does impact the operations. There are multiple contract forms which exist in the market. A lot of those are developed innovatively through buyers and sellers kind of figuring out arrangements that work for them in terms of risk allocation and value. And so if you're a central agency looking to create these types of structures, you've got to really think about how those things affect your incentives and how you maintain skin in the game for battery operators and storage operators to continue to participate optimally. And finally, valuation is complicated. Cool.
Thank you
I'll
very
let you
much.
ride on
No, that was great. All right, thank you, Farhad. That was, again, for me, really interesting to see that kind of, that other perspective and how you, I don't know, I'll maybe get to some questions, but the session before this, we talked a little bit about LDES and how to kind of lock in the market value and take that to a bank and actually get financing, and how do you got to work through all the practicalities of securing revenue streams. So anyways, it was a really interesting perspective. Our last speaker is Cate from Fluence Digital. Going to talk a little bit about bidding, resource bidding and market design. So again, a little bit more of the owner operator perspective here to tie things together.
Yeah, thanks. First, I just want to say, like, those three presentations have been really good because I do this every day and it's like 100% vibing with what I deal with on a daily basis. So great job so far, everybody. I'm Cate. I'm the Principal Director of Energy Markets at Fluence. I've been there about 4 years. I spent 16 years at Southwest Power Pool doing energy market operations and energy market design to varying degrees of success, as Daniel Harless over there knows. I got to start with a little bit of marketing material to go over what we do, or they won't pay for me to come. At Fluence, our mission is transform the way we power our world to create a more sustainable future. It is really something that we focus on, and decarbonization, net zero. There is a big push for that in our company, and that's what a lot of us are trying to do. We have both energy storage solutions. So we have 38 gigawatt hours of energy storage that we've deployed globally. We also have a services division that does around 9 gigawatts of battery management, energy services. And then we also have our optimization side, which is Mosaic, where I work and spend most of my time, which is AI optimization for bidding renewables and storage. That's in ERCOT, CAISO, and the NEM markets right now. Heavily in NEM and CAISO, little bit in ERCOT. We are moving into MISO and some other areas. We like to think about the problem for us as someone who is building energy storage, but not a project developer. We're just selling energy storage. And we're also bidding into markets, but we're not a market participant. We create bids, we do energy valuations, but we're not actually a market participant. So there's just this kind of flow that you see of commercial dynamics, advancing technology, and regulatory changes. Once something becomes loosely viable and it starts getting built in the markets, it goes in, the technology advances. If you look at, we started with 1 hour batteries, 2 hour batteries, 4 hour batteries. As that technology becomes more and more prevalent, we start to get regulatory changes like we see at ERCOT and CAISO, and all of those things come back and start the circle over again. As this regulatory change, maybe it's an operational change to how the batteries can participate, then that restarts the commercial dynamics, and then we advance the technology, and then you guys make more changes, right? So that's kind of how that flows over time. As everybody here probably knows, storage is fairly complex to bid compared to other assets, right? The fuel is based on the opportunity cost in the market. They can operate bidirectionally. They have unique constraints like cycling, ITC, POI. There's a significant amount of constraints that I've had to learn about and deal with operating storage over the time. And as with any new asset class, you know, when wind and solar first came in, we had to make a lot of rule changes over time to do that. And that's happening as well. So pretty much every market in North America and across the world has some storage-based change that they're looking at, right? And so you have to stay on top of that and move with that as we go. So focusing more on bidding, Fluence Mosaic is our product that we use for bidding into the energy markets. Again, 17 gigawatts. We have 25 or something market experts on staff. A lot of operating hours, really good uptime. Obviously wouldn't put that on there if it was bad. So, but when you look at what we do, it's kind of a three-phased approach to bidding into the markets. We start with a price forecast. It's a nodal-based price forecast specific to each asset that we're bidding. Then we do a physical optimization that attempts, based on that price forecast over a 48-hour period for the day-ahead market, 48-hour period for real-time, attempts to find the physical schedule for that battery that maximizes revenue, right? Within those constraints. So some people have cycling constraints. Some people can do one cycle. Some people can do two cycle. We see a lot of contracts that are 365 cycles a year, but not necessarily, they don't really care if you can do 2 or 3 cycles a day, right? So there's a lot of variability in what we see people bring into the market and what we're bidding. But coming out of that, we try to get a physical schedule for energy and ancillary services that maximizes revenue for the battery. And then the bid formation is we're trying to effectuate that physical schedule as a bid to the market, right? So we've got the physical schedule that we believe is optimal based on the prices. Now we need to bid into the market to make sure that we clear in those hours that we want to clear and operate the battery. This is just a little bit about kind of over the last 3 or 4 years, the changes we've made to our optimization and how we think about bidding and how we do the optimization. So we started in 2019 with a deterministic optimization that was using a single price forecast, right? So single shot optimization, single shot price forecast, just assuming the price is whatever it was forecasted. Energy forecasting is very hard. And so there's always going to be some differential in what you expect the price to be and what the price actually becomes. Obviously, most of you are ISO RTO people, so you know a single megawatt can shift the price from being $100 to $500 if you're short, right? So that does make price forecasting difficult. So we went with a stochastic optimization approach using historical pricing scenarios, right? So getting a more of a probabilistic type price forecast and letting the optimization know that there are multiple potentialities for the price. And we saw about a 26% gain in our performance doing that. But we still wanted to get better. So we moved to phase 3, which is stochastic optimization with more of a machine learning price scenarios, right? So this is more, really the only difference between 2 and 3 is that 3 has an additional loop in the forecast where we're training on a more recent set of data. So in step 2, it's 365 rolling days of data based on historical prices, historical net load deviation, all the, renewable forecast, all the things you would bring into a forecast. Step 3 is a tighter train model over maybe 2 months, 1 month, and it varies depending on the node and depending on the situation. So we do have some control over that, but it is trying to bring more recency into the forecast, right? Maybe there's congestion event, maybe there is a load pocket, an outage, something like that. So we're trying to bring more recency into the price forecast. And we're also training not just on more recent data in a smaller data window, we're also training on that error, right? So if we're trending towards where we're over forecasting regulation up, we're feeding that error back in and adjusting the weighting of the probabilistic forecast from step 2 to kind of start training the model and pushing it back towards convergence. And then the final change that we've just made over the past few months was day ahead and real-time co-optimization. with that same set of scenarios. So when we first built this model, it was very much built from a CAISO perspective and for actually a couple of customers specifically in CAISO. And it used a very much a cascaded approach of you go into the day ahead market, you take all of your positions in the day ahead market, and then real time, you're largely defending your positions, right? So maybe looking for some arbitrage opportunity, but you're largely defending those energy and ancillary service positions that you took in the day ahead market. Over time, prices have shifted and changed, and it depends on where you're at. I mean, certainly ERCOT, right? There's tons of opportunity in the real time. You don't necessarily even want to take a position in the day ahead market if you don't have to, because there's a lot of real time price spikes there. In CAISO, it's still probably better to go into the day ahead market, but if you're in North instead of South, North has a lot more real time opportunity than the South does. So anyway, we wanted to make that a decision that the customer didn't have to make on their own, that we made for them. So this optimization we have now, it takes in the day ahead prices, it takes in the real time prices, and it makes that decision of these hours you should be in the day ahead market, these hours you should be in the real time market. And obviously the customer has control over their risk and all of the things, levers you would want to pull. But essentially it's bringing that full cohesive day ahead and real time co-optimization. This is something that's actually just a trend. It's not super cool slide or anything, but we've seen a big push in the market from originally everybody was very hands-on. Everyone we were talking to, every customer wanted complete control of how they optimize the asset. They wanted to play with all of the settings. They wanted to do all the things. But over time, a lot of these IPPs are coming in and they really just want to check, right? They want to build that asset. They want to get a check for it, and they're not necessarily concerned with running the asset. And so there's been a pretty big shift, certainly in ERCOT. We don't see it as much in CAISO, but a ton in ERCOT is people coming to us and saying, hey, I don't actually want to run this asset. I just want you to send me a check. So that's some of the stuff that Farhad talked about. So we've kind of shifted our model too, is from just purely subscription-based to, hey, we can provide these energy market services for you. And we have these things that we call human on the loop or human in the loop. Human on the loop, I call as introducing energy market analysts and people into feeding the right inputs into the optimization. Human in the loop is more like just going out and making a change of, I've decided I'm going to discharge in hour 16, right? I don't really love human in the loop as a person who helps other people operate their storage. Because I tend to think there's a reason we built all of these complex models to do this optimization, and stepping outside of that can lead to an error. And we see that happen a lot, which is, okay, I have a day ahead position. Maybe you forgot you had a day ahead position, or maybe you don't know how it's going to affect your ancillary services over time. So just stepping outside of the optimization and saying, I'm going to discharge in hour 16, even though that's not what the plan was, creates some issues. So I trend more towards human on the loop, which is, why did you want to do that, right? So if there's an operator at operating the battery and he says, I want to discharge in hour 16. Well, it's probably because he thinks there's something that's going to happen. So did you think there was going to be a price spike? What reason did you do that? Let's feed that back into the optimization so that we're making those decisions that way, instead of just making, loosely, I would call them blind decisions to just discharge. This is a real, I'll do this super quick. We get this a lot when you're moving into multi-cycle operations. A lot of people look at the batteries and they think of it as a TP4 type of thing, right? Of I charge in the 4 cheapest hours, I discharge in the 4 most expensive hours, and that's all you have to do, right? And that'll maximize the revenue. It's rarely the case, certainly with ancillary services. And so this is, a true customer question of, hey, you didn't discharge at the peak. So this is what we actually did from a mosaic perspective of, it was a multi-cycle asset, right? So we carried over some state of charge from the second day. In CAISO, it's pretty much insane to not just charge during the solar period, right? There's very few opportunities to do anything other than operate this battery as charge during 9 through 14. But if you're multi-cycle, you can't really hit both of these peaks unless you're carrying over capacity from the second day. And so to hit this morning peak, which if you look at the difference between the morning peak and the afternoon peak, it's pretty much flat, right? So my arbitrage value between discharging in the morning and discharging in the afternoon doesn't really change. So I can, on a multi-cycle battery, go in, do almost a full set of 4 discharges in the morning, charge fully, still hit a decent portion of the afternoon peak, but still have enough to carry over so I can do that same thing tomorrow, right? And so we did a deep dive with a customer, and it increases revenue the way we're managing it about 52%, and you're discharging about 26% more capacity in the market, which is how you make money. This is just talking about human in the loop. Again, we see about, on average, about 15% revenue increase when we are helping a customer deeply and trying to feed that into the optimization than if we just let them run it themselves. Okay, so now let's get to the actual, now you can see the difference between the slides that I stole from marketing and then the slides that I made, which are just like blank white slides. So kind of like market thoughts, right? So our biggest thing is all products should be biddable, right? I was at SPP, I worked on ramping product, I worked on uncertainty product, and I thought loss of opportunity was perfect and there was no reason to change it. But what happens is there's 2 things. One, loss of opportunity, certainly in the real-time market, is only for that interval, right? It's not taking into account that I have positions later in time, and that because I'm a battery and not a conventional asset, that can ruin my positions for later in the day, right? So that is one piece of it. The other piece is we want to be, at least Fluence does, I assume all the optimizers do, we want to be good optimizers, and we don't want to be the people that you guys talk about in the back room of like, hey, they're not really good at following dispatch, or these batteries are creating this problem, right? We don't want to be that. So the biggest thing that we face in managing a battery is state of charge uncertainty, right? So state of energy, how much is my battery going to have? How much am I going to get used? If I don't know if I'm going to clear for a product or not, it makes it very difficult to decide where my battery is going to be. Now, I'm not asking for you guys to tell us the price, right? I'm asking for, if our price forecast was good, right? And if our optimization was good, that we should have a reasonable expectation of what products we clear for. But if it's loss of opportunity, we can't really get that. So that makes it very difficult from a battery optimization perspective. A, obviously for revenue, which is what my customers are concerned about, but B, what I'm concerned about is, again, being the bad guy. So the more certainty I have, the better I can be as a battery. Multi-segment bids is the same thing, right? So if I only have one segment on my bid curve, let's say for ancillary services, which I'll talk about on the other side, are the biggest risk to my state of charge, right? I'll give you CAISO example, right? And CAISO does a really good job of publishing attenuation factors to help us understand what they think they're going to deploy from an ancillary service perspective. But there's a lot of hours where the CAISO expectation is 20% and we have an 80% hit to state of charge, right? So there's a big ACE event or something like that. Well, what I would like to be able to do is to quantify that uncertainty, which I have, but I just can't bid it, but quantify the fact that clearing 10 megawatts of regulation up or down versus 100 megawatts of regulation up or down create a different model for me and create more uncertainty. So if I can't put that uncertainty in my bid, I'm left where I just have to bid it all into the market, and then I end up taking that hit from a state of charge management perspective. Unrestricted ability to operate within the battery parameters. This is fairly CAISO specific, although I see it in other markets as well. As just originally in CAISO, we could bid double the inverter. So if I'm down at the very bottom, it's a 100 megawatt asset. If I'm doing 100 megawatts of energy, technically I can do 200 megawatts of regulation up. They've made some rule changes to not allow that, which, again, I totally understand kind of the thought process, but that was a significant hit, probably around a 33% hit to battery revenue in CAISO, those changes. And when you talk about investment case and you talk about how can we get more of this on the grid, unilaterally making a change that removes 33% of the revenue potential for energy storage is not necessarily the best way to get more energy storage to come. We prefer a reward restriction over SOC management. So Kenneth kind of talked about that of, hey, we're going to come in, we're going to check your state of charge. If you can't deliver, we're just not going to award you that product. CAISO and a couple of other markets will actually manage your state of charge to make sure that you can deliver on that ancillary service obligation you had, which I, again, as a grid operator formerly, I understand that. But I would say 90% of the time, A, we were going to get there anyway, and B, it was done at a time that was detrimental to my state of charge overall and my revenue overall. And they don't necessarily know a lot of, I don't expect RTOs, ISOs to be able to model all of these individual battery. Whoa, I just saw that there's a clock there and realized I'm what getting.
You got a minute, you got a whole minute. No.
I don't expect you guys to be able to model all these individual constraints that all of these batteries have, right? So when you do state of charge management, you're inherently taking on that for us, and that doesn't always work because you don't have all of the information, nor do I expect you to. So I'd rather you just not manage my state of charge. New technology should not be penalized for shortcoming in regulatory operations and modeling. That's just one of those things of, I think every time a new technology comes in, we kind of gravitate to, let's make a change for that and let's fix that one piece. And we think that if we're making that change because this new technology came in, it's okay for that new technology to be the one that is harmed, right? But if you look at it holistically, shouldn't everyone to some degree bear some of that risk? I gotta hurry. So bidding best practices, LMP ancillary service price forecasting is hard. That's why we moved to a stochastic model to consider a wider range of possibilities and create a schedule that does think about the fact that yes, the P50 is $50, but there's also a 20% chance the price is going to be $200. And so we've saw significant improvements by building schedules that address that. Ancillary services are a great way to add revenue, but like I talked about a couple of times here, it introduces a lot of uncertainty. And typically that uncertainty is almost always materializing towards the end of the day, towards the peak where you want to discharge. So if I have early day uncertainty, what's going to happen? Well, I'm going to be left short towards the peak, and that's where I want to discharge. And that's also where the RTO ISO wants us to be. And so that ancillary service uncertainty creates problems both for the RTO ISO and for the operator. Customers, assets, and operators, they really need to have a strong understanding of what their risk profile and what they want to do in an energy market is. We have a lot of people who come in and they just think it's all going to work perfect. And it's like, well, no, there's risk in ancillary services and there's mitigation that happens. So there's a lot of things you really need to work with your customers on to make sure they understand how to just operate in an energy market. That kind of aligns with number 4 too, which is more focused. Well, 4 and 5 kind of jive together where it's focusing on the cost to provide a service. I would say the last 3 to 4 years, most people's model from an optimization standpoint is a price taker model, right? I forecast the prices, I go set a physical schedule, and that's it. I'm just trying to get the award. But no one's thinking about what does it actually cost me to provide this service, either from a technical like fuel perspective of where I'm getting the fuel, or from a risk perspective of if I do go for ancillary services, what does that mean for my risk profile? And so that is something we're still working with customers on. And it kind of moves into number 5, which I think is the most interesting piece of all of this is once we move out of the price taker model, how you bid a bit when BES is truly the marginal asset, it becomes much more of a game theory type of exercise for price forecasting and bid creation. Because right now, the marginal units almost always gas. Everyone knows what the heat rate of the marginal units are going to be, and everyone knows what gas costs, right? So it's pretty easy to kind of generally forecast outside of, market events. But when that model is applied to BES, everyone has a different model for what they think their opportunity cost and what the LMP is going to be. And I think it's going to really shift how we forecast and how we address those things. So sorry I went a little bit over, but thank you. It's great.
Thank you. Yeah.